Hey, good evening, guys. Ken at Tortoise Capital Nightly Strategy Podcast for Sunday night, November 27th, 2022. We didn't have any charts posted in the chat room, so we're not going to review any charts tonight. I owed Luis an answer to a good question that he had asked me last week. I just haven't been able to get to it. So this is as good a time as any, and thank him for the question. So he was listening to a video where I was explaining to Matt the concept of frog champions, the frog quality number, and compound critical states. And he started looking at the weekend and the daily report, and also started looking at the signal to noise ratio, and comparing that to the gain stat and the fail stat sections. And he noticed that in some stocks, the average gain is significantly higher than the average fail for the last 30 days. And so he extracted some data and chunked it into Excel. Always a good idea to see what came out of it. So in yellow, he put the average gain, in orange, the average fail, and in blue, the average gain. And as you could see, he thought that this could turn into an indicator, so that when the average gain is higher than the average fail, you can be long, and vice versa. He also compared the results to the ADX statistic in the report, and it seems that they track similar behavior but not quite identical. And there's a reason for that. So I encourage you guys to use the report, as a rich source of ideas, and this shows an example of why. So just some quick definitions of concepts. The Frog Champions is a list of symbols, ETFs, large cap stocks, some indexes, that exhibit persistent intraday trending behavior, meaning that their average follow through intraday is greater than that of the average member of the S&P 500. So what that means is you're getting intraday directionality, which is excellent for the frog system, which really wants, after a move to a measured, let's say, low of the day, and then it moves a frog box off the bottom, what you want is a consistent intraday directional move where you're trailing that with a frog box, and then when it reverses, you can get an exit, and then make this gain. So the frog system prefers frog champions, and so Tony DeQuick did an amazing piece of statistical analysis that's documented one of our research weekends. I'm not going to replay all of it, but suffice it to say that he established a hyper server in the cloud, and then ran tick data on every symbol in the Dow, in the Dow Jones and New York Stock Exchange, I should say, the 5,000 stocks, and all the ETFs back 30 years, and ran combinations of different frog strategies to find out the symbols that behave the best, regardless of which particular rule set. So what it really came down to were symbols that exhibited excellent intraday directionality persistently became frog champions, and we have a list of those that we provide in the day trading course and the foundations course. The frog quality number is simply a statistical measure of the average range of the last 30 days divided by the standard deviation, and that will tell you if it moves this far on an average range from 0, and you have 3 standard deviations inside that stack, that becomes a favorable a favorable number, because you can let it move a full frog box off the low of the day with a reasonable expectation that at some point it's going to move an average range, so you can get 2 units of reward versus 1 unit of risk. Now there's other symbols that are of interest to us. Frog quality number is only one of the things that goes into making frog champions, but it's a useful way to determine what the statistical posture of that symbol is. Compound critical states you see us talking about in sniper trading, which is where we're looking at location in 3 different time frames: long-term, mid-term, and short-term. We look back 150 days, 30 days, and 10 days. And we're looking for symbols that are on a scale of 0 to 100 in each time frame, and that being the 50. We're looking for symbols that are either extremely overbought or extremely oversold, or right exactly on that 50-yard line, plus or minus a few points. And if we have something that is in an extreme condition by location in 2 out of those 3, plus is extreme as measuring short-term volatility, then we have something that is in a compound critical state, because having an abnormal price location and abnormal volatility leads to outsized short-term moves. And so a compound critical state is something that's radioactive, ready to explode. And we love trading that because volatility is our friend. Now, the gain stat and the fail stat have to do with the last 30 days. And what we're interested in is the average composite day. So if we had, what we do is we measure every day from the open, if that's the opening, and then we find the low of the day. Whenever that occurs during the day, we say that the distance from the open to the low of the day is how much it failed from the open. And then we go find the high of the day, wherever that is, and then we say the distance from the open to the high of the day, whenever it occurs, that was the gain of the intraday move. And then from the high of the day to the close, we call that the fade. How much did it fade from the high of the day into the close? So each one of those is expressed as a percentage of the closing price. Percentage of the closing price. And that gives us some sense of how much it failed, how much it gained, how much it faded. We already measure from the high of the day to the low of the day because we're measuring the range. And then going from open to close, you can find the net of the day. We're actually interested as intraday traders what those travel distances are between the open to the low, from low to the high, and from high to the fade. In fact, that's our preferred target. We would like to see things happen in that order, where it opens, sells off, has a morning hook, moves to the high of the day, and at some point can't go any higher, and then fades into the close. That's sort of the perfect template for a standard day. Now, it doesn't always do that. There will be days when from the open it goes to the high of the day, and then the low of the day, and then to the close. So this is a case where the fade is actually a positive number. In this one, from the high of the day, the high of the day, even here, that would still be the fade. I'm sorry. From the high of the day to the close is always a negative percentage. And in this case, the low from the open to the low would still be the fail. Okay, and then from high of the day to low of the day is still the range. So we're interested in knowing what those numbers look like, so that we can understand what a standard day. So if we take at the close, we take today's price. That's now the -1 day, because at the close, this is now history, and we find that open, high, low, close, we can still measure those distances. The fail, the gain, and the fade, and the range. That gives us information. Now, if we go back 30 days, we're going back 30 days and computing all of those numbers, we now can take the 30% that it failed each day, and then we can say what was the maximum fail, the minimum fail, the average fail, and that's the one that we're interested in. And we can find plus or minus 1 standard deviation on that as well. And that gives us some sense of how much we could expect it to normally fail if all things remain equal. So now when that symbol opens and we see it fail a certain distance, and then it starts to hook up, and then it might be hitting our SSC entry or a hybrid frog or any of our intraday patterns, and we put some kind of risk box on it, and then we get an entry, we can say, well, this is still the working low of the day right now. And if that percentage is equal to the average of the fails of the last 30 days, then we're not surprised that it found the low of the day quickly and is starting to move up. We can then say from the open to the high of the day, if this just gives us an average day, what would be the average move off that low of the day? We can actually we can put another standard deviation on top of that, you guessed it, and that's the range stat. So now, once we see the turning point, we can actually begin to start calibrating our expectations for what the size of the move to the high of the day might be. Now, if that happens fast and then starts to hesitate and begins to fail, we're entitled to believe that maybe we've seen the move of the day, and we might be ready to capture that with a 2-hour battle drill. But if it blasts through there, then this might be one of those where it's going to go all the way to a range stat or even beyond. So it's through the use of the gain stat and the fail stat that we can begin to start anticipating the size of normal moves, so that when we know what those limits of normal are and it behaves differently, we know we're into an abnormal move. Now, the signal to noise ratio is a similar idea in the fact where if you take a standard candlestick and it opens here, and at some point it maxes out at the high of the day and the minimum out at the low of the day, and then closes here, the normal interpretation is that everything above the real body of the candle consists of this rectangle, which is from open to close, or it could have been, if this was a solid candle, from open to close that way. But this is the net directionality from open to close, is the size of the real body. So that directionality for the day, in this case if it was negative, we would say that real body equals the signal element of the price action for the day. That was the net difference from open to close. And then we would say that the price action above and below, between the edge of the open and close to the high and to the low, we would call that noise, because it couldn't hold that price. And so if we take the entire range and we say that signal plus noise equals 1.0, we can say what percentage of that bar's move was signal. So if we plotted the open and the close and we found this was here, that might be, let's just for sake of argument call that 40% of the daily range was in signal from the open to the close, and then maybe 30% and 30%. So maybe in this case 40% was signal and 60% was noise. We would give that a signal to noise ratio of 0.4. Well, now if you go back 30 days and you compute all of those signal to noise ratios, you can also go max, min, and then what you want to know is the average, and then plus or minus 1 standard deviation. You now can define what the normal intraday directionality, the net of the day, is. And then if you stack, let's say you had 100 symbols that you like to trade, and you could stack them all by signal to noise ratio, and something that was up around on an average of 0.7 would be an amazingly directional intraday mover, whereas some things that are down around 0.3 end up being very choppy intraday, that they move to the high of the day and then the low of the day and they settle down, and they have a very small amount of net daily move. Well, on those kinds of things, when you see large moves and then begin to reverse, you're more inclined to believe that it's going to fade back into somewhere around the average, somewhere around the open, that the open and close are relatively tightly compressed. So long tails and small real bodies. Whereas something that has a large signal to noise ratio is something that is characterized by an open and then maybe a large move and close as well. So it is mostly signal. So all other things being equal, having a large signal to noise ratio tells you that that is relatively directional intraday, which makes it a very good symbol to be trading intraday, like a frog champion or any of our intraday patterns. Now the ADX statistic is a statistical treatment of the average directional index, and that's just teasing out directional behavior over a 14-day period. And if you have a symbol that has very little directionality over the last 14 days, his ADX number is going to be small. If you have a symbol that is mostly directional, it's going to have a large ADX, and most of that is going to be positive because each day you are measuring how much of today's price action was outside of yesterday's range. That is a measure of directionality. So when you get a trending move that is staying outside of yesterday's range, you're going to have a very large ADX. So you can measure the strength and the pattern of ADX by looking at our ADX stat. And so what you may find is that the normal amount of directionality in a symbol over some periods of time, you might say, hey, in these choppy periods, ADX might have been between, let's call it 15 to 20. But then when it started to become very directional in either direction, that ADX might have gone up to 30 to 40. So if you measure that ADX and you look at the ADX statistic, what you're interested in things that are beginning to show strength of directionality that is abnormal. You're already seeing the trend develop. By the same token, if you see something that is abnormally non-trending, that means you're getting some very choppy motion in here. And then when it gets super abnormal, you say, well, how long can it stay choppy like that? That's where you might start putting a bracket on that and say, now, when this starts moving back up out of that stack in either direction, I might have an indicator that tells me a directional trend is beginning because either the bulls or the bears are starting to work. So the ADX stat is another area on the chart on our daily reports that you can find that data. So I just wanted to hit that real quick and just say, show you where on the daily reports those can be found. Yeah, so here's, this is just using last Friday's numbers. Yeah, so this is the concept of the fail stat. And what I've done is I've taken the standard symbols that I like to trade the 30 elements of the Dow, plus some specials. I teased in some specials like Tesla because I'm interested in that one. And then 30 large cap ETFs, including all the S&P sector spiders. And then this is just measuring what the size of the average fail has been. And then that gives us the, I think this is in dollar figures. That tells you from the open, if you see it starting to find support at an average fail, and it starts to roll back up, that's the time when you might be ready to enter with morning hooks. And that's my favorite pattern, is that when you have a gap down and then a quick sell off to the fail stat and starts to reverse, that's the one where I make my bread and butter, because that is either going to work, or after it gets a false start, it fails again. When it fails through the low of the day, we now have probably a collapsing dragon, which is our favorite pattern. So that's how I use the fail stat. And then with the same population, the gain stat is simply taking a look at from the open to the high of the day. If this starts to fail after an average, after an average gain, I'm really looking for profit taking or being ready to enter on the short side, like on a reversion back to the mean, or somewhere near the open or close, believing that maybe that is not going to hold. Same concept. Now, because these are only looking at 30-day lookbacks, it's okay to report that in terms of dollar value. If I was looking at longer periods of time, I would convert that to a percentage. But sometimes it's handy to see what the size of the dollar boxes are in terms of actual price. The gap stat is a similar idea, only what we're looking at is finding the size of the absolute value of the gaps of the last 200 days, because we want to know what is abnormal gaps. So in this case, an average plus 1 SD absolute value would be an exceptionally large gap, which tells you this could be an exceptionally big intraday move, because we know that there's a correlation between the size of the gap and the size of the follow through, and that's all expressed inside here. My contention is that if you trade certain symbols a lot, then you should really have all these numbers at your fingertips, because you're always ready to go. Now, this is the explanation of the signal to noise ratio. You can see that's the same thing I drew before, that the real body is the signal and the tails equal the noise, and that the aggregate gives you an index number between 0 and 1 for the strength of the signal versus the noise. What I do is, again, I'm looking at my standard tradables here. And the ones that are in green compared to this whole population are the ones that have abnormally large signal to noise ratios, and the ones that are in red are extremely quiet. So you can see that in some cases, like emerging markets and treasuries, are very directional intraday, whereas Cisco, Procter and Gamble, agriculture, those tend to be much choppier. So that's how I'm using signal to noise ratio to find tendencies, and that's everything I want to cover on that in answer to Luis's questions. So thanks for your kind attention, and that's everything we got for tonight.